What exactly are LEAPS? LEAPS is short for a long-term equity anticipation security. They are long-dated options contracts. LEAPS can be for call options, and they can also be for put options. However, since they are a long-term strategy, most LEAPS are call options. The expiration date for a LEAP is at least a year out, but it can be longer than that. LEAPS are used to make a leverage bet on the direction of a stock over a longer period of time. They offer three big benefits. Benefit number one is they lower your cost to obtain exposure to 100 shares. Benefit number two, because your cost of entry is lower, your potential return on the investment is much higher. Benefit number three, they give you the opportunity to use the income-driven strategy of a poor man's covered call. We'll save diving into a poor man's covered call for a different video. The negatives with LEAPS are the following. They are higher risk, and you're going to see much more volatility with LEAPS. You don't actually own the stock when you buy a LEAP contract, so you're not going to receive any dividends. Let's go over an example. Let's say you're bullish over Intel over the next 2.5 years. The stock currently trades at $27 a share. To own 100 shares, it's going to cost you $2,700. And in the money LEAP contract over the next 2.5 years that would require little movement in the stock would cost $900 instead. That's a third of the cost of buying shares for the same exposure. To break even on the LEAP contract, the stock would need to be $29 a share at expiration, which is 2.5 years out. If you bought 100 shares, your break even would be $27 a share. The max loss on a LEAP contract is the money you put in. So in this case, $900 per contract. And that would occur if Intel was under $20 at expiration. The max loss on any stock you buy is when the stock hits $0. And that's why LEAPS have more risk to them, because you can experience your max loss at a much higher share price. Let's assume that at expiration date, which is 2.5 years out, Intel trades at $40 a share. The returns on the LEAPS would be 123%. The returns on the stock would be 48%. That leverage return is the biggest benefit of LEAPS. Now, LEAPS trade like common stock. You can buy and sell them during market hours. You do not need to hold your options contract until expiration. If, however, you do hold your contract past expiration and the contract is in the money, then you'll take assignment of 100 shares per contract. Typically, most investors and traders will close out of their contract before expiration to avoid assignment. Now, if you're interested in buying LEAPS, Webull will allow you to do this with $0 in commissions for options. If you sign up with the affiliate link that's provided in the bio, you'll get 12 free stocks. If you deposit $100, this channel will be rewarded with a free stock. But that's about it for LEAPS. If you have any questions, comment down below and follow this channel for more stock content.